Good afternoon and welcome everyone to today's US market update and our fourth quarter earnings review presentations. Great to see so many on today's webcast. My name is Kelly Main, Associate Portfolio Manager, and with me today are Fortrend CEO Joe Forster and our portfolio managers Chris Wallerman and Stephen Lyle. We welcome question and answers throughout the presentation. Please feel free to click on the Q&A tab on your screen to ask a question. We will do our best to answer it in a timely manner and as best as we can. With that, I'll now turn the presentation over to Joe.
Thanks, Kelly. In December, I wrote bifurcation is the greatest that I've ever seen. In other words, the diverse in valuations. We had seen some very, very high valuations for growth stocks and tech stocks. And I did something, a table called my sub-10s, which is about 50 stocks that traded at below 10 times earnings with very high yields. And it was the greatest diversification of values I had ever seen. Since then, we've seen this absolute collapse in the differences in the valuation. So this is the period for bifurcation reconciliation, as there's been a major adjustment in the markets after what we saw at the beginning of December. As a general advice, the market overall was down 2%. So we did see some big tech stocks fall, some big high growth stocks fall significantly. Everything from Facebook or Metaverse to many other chip companies like AMD and NVIDIA. But then there are some still very high quality companies that are performing very well in high growth, and including the stocks that we own, Qualcomm and Google, have done very well. Our earnings estimates for 2013 are 8.6% higher than 2022. And so we are seeing a continued above average growth in the forecasts for earnings. We would expect with inflation, let's say, well, now it's 7%, but inflation and volume and some leverage into that, you'd expect in the long-term earnings to grow about 7 to 8% a year. They're above that because high inflation rates at the moment. So we've seen a big surge in inflation. One of the big reasons for this shift in the markets is Joe Biden, President Joe Biden. And he passed an act for recovery from COVID in March this year, which put $1.9 trillion into the economy and caused excess growth. And it's just been a total disaster, this bill that was passed in March for $1.9 trillion, causing a big ramp up in economic activity and saddling future generations with a large amount of debt. So that'll wear off. And his next act, which is the Build Back Better Act for much more money, is not going to pass. With midterm elections coming up, that is dead in the Senate. So we'll talk a little bit more about that. But this overstimulated economy has resulted in inflation, particularly in raw materials and in oil, but also in food, which has benefited our investment in Tyson Foods very significantly. With new estimates out for 2013, we're at only 18.4 times forecasted earnings. That's a reasonable number considering where the 10-year treasury is below, say, 3%. It's at 1.9. It's increased from, say, 1.5 to 1.9, a big increase in the 10-year treasury as the inflationary numbers are causing a lot of expectation that the Fed needs to act soon. So they will do quantitative, not easing, but tightening, but quantitative tightening starting in March. They'll start to work off their balance sheet, and they'll start to raise interest rates potentially 5 times this year to try and overcome this horrible stuff that President Biden has put in place to cause this dislocation in the economies. So it's overstimulation, particularly oil, raw material. We see, for example, the price of aluminum or aluminium, as you say in Australia, surging, but oil just going nuts. So we're going to talk more about oil. But it does drive up the weighted cost of capital, the weighted average cost of capital. And when you drive up the weighted cost of capital, it reduces the net present value using discounted cash flow models when you have a longer term growth. So I did put in here a slide showing the formula. So the discounted present value is the sum of the future earnings streams over many years, 1 over R being the risk rate or the weighted average cost of capital adjusted for the risk in there. But I did want to show you that this stuff does come down into formulas where you look at the net present value based on future earnings streams discounted for on the R there, the cost of capital or interest rates. So when you have a higher risk-weighted cost of capital, you have lower valuations. So the market, as I said in December, bifurcation is an understatement. Never a more diverse range in values where we saw very high values for some growth stocks, many stocks trading like they did during the dot-com bubble, 50 times forecasted earnings, and a lot of stocks have come tumbling down. And some of those that have come down are Vroom, Vimeo, DocuSign, and Cloudflare, Zillow, Teladocs, which has been very successful, Palantir, and Roku. Many which I've said I don't understand the valuations of, but these stocks are all down, and many more down 50% in this short period of time. Whereas sub-10s have surged, and of course we have 3 sub-10s in our portfolio, and they've performed very well this month. But one of our stocks, it is a very fast growth stock. Moderna fell 50% this month. Fortunately, we have other stocks that perform very well, countering that. So the Fortrend relative value model performed in line with the market for that period. Fortunately, the last 2 days, we had 2 stocks that were the biggest leaders in the biggest upward movers in the S&P 500 index. Last night, Amgen was the biggest surge in the S&P 500 index. The day before, we had Tyson as the biggest surge. So we had a bad result with this Medtronic, with Moderna. We're confident it'll come back. And I think it's a double down situation there. It's crazy it being sold down the way it is because it is not a growth stock. It is trading on the expectation they'll make a lot of money this year, but that they're trading like a one-hit wonder, and they're not. They have a lot more to do in the pipe. You can see here the big movers: Allegheny to the upside, Halliburton 50%, Occidental, Marathon, Royal Dutch, Alcoa. Skipping Exxon is a unique situation. Skipping Hong Kong Shanghai Banking Corporation, but down to Exxon, Apache, Schlumberger. See, all of these raw material companies are sub 50, high yield, low PE stocks. Whereas to the downside, Etsy. Now, Etsy is a platform for companies to offer their stores online. It's basically, here is a shopping mall and we're going to give you a storefront and you can sell through this. Block used to be called Square, one of the highest flying US technology stocks. When you go out in the world and you don't stay at home from the pandemic and you get a haircut like I did yesterday, the lady has a little white device that is produced by Block where I scan my card and it goes straight into her phone. So these payment systems are point of sale systems. They're not online systems. So you would think that Block would be a stock that would benefit from the recovery, but Block is buying an Australian company, Afterpay, which you're probably familiar with. You're going to receive Block shares now. And Block used to be called Square. Also on the downside, Netflix, tremendous growth in Netflix until we had a slowdown in subscriber growth this quarter. Zoom, which we're on today, PayPal, down significantly, another very expensive high-flying stock. They're being weaned off of the eBay platform. Of course, they were spun off by eBay in 2015. And Spotify down. Meta, which is BlackBerry, down. Meta, which is, sorry, I was looking at BlackBerry above it. Meta, which is Facebook, is down, and Salesforce down. So the stocks coming down are those real long-term growth stories that are changing the world, where you move fast and break things, but they got overvalued. So the big reconciliation of the bifurcation story that we talked about in our last report, all reconciling. And you can see here on the bottom over in the right, oil stocks are up and the FANG stocks are down. So oil up 30%, FANG stocks down 17%. Then there's also some semiconductors and software stocks down 8 and 10%. So we're really seeing this big rotation out of the growth into the metals and into the oil stocks. Earnings estimates for next year, you can see those earnings estimates are going up for many different industries. Dine, which is the restaurants and hotels and things like that, is up very significantly because there's a couple of cruise companies in there that are expected to return to profitability. So the earnings estimates for Royal Caribbean, the Miami-based company that competes with Carnival, so their earnings estimates basically go from 0 to 100. And that's why you have a big percentage increase in that sector. But otherwise, transportation up significantly, as we're seeing a similar thing happening with some of the airlines, 0 to 100. Oil is going from 50 to 75, and that's why we're seeing a big increase in the earnings estimates for oil. And so that's showing the relative value model, which gives us a sense for how Wall Street is pricing stocks on the scale on the left, the price divided by the sales. We're normalizing the price earnings ratio by sales. And of course, on the horizontal axis, we have the earnings using Wall Street forecasted earnings estimates, showing that way over on the right here, we have biotech with a 35% return on sales, which is terrific. With very good margins coming out of companies like Amgen, which we recommend, and Moderna, which we recommend, and many others in that sector. And whereas over in the bottom left, we have the auto industry really increasing their overall margins as you see the EVs taking hold and really getting a lot of critical mass. And that could, I wanted to bring up, and maybe one of you could mention this to save everyone from my voice for a little bit, but there's a company that came public last week that prides itself on not being Chinese. That's LG Batteries, LG Energy. We want to mention that. It's a new listing that just came out of
South Korea, LG Energy Solutions, which will be another EV provider of battery solutions. And they use lithium and I think copper in their EV batteries.
Very exciting new float of a company out of South Korea, which does some wonderful things, but they sell themselves as not being Chinese, which is a good pitch in the current environment. Macroeconomics, as we move on in, and if anyone has any questions, please, Kelly's monitoring for you to chat. We do thrive on the conversation, and it's difficult here being online without being able to see you raise your hands or question or see the look on your face when you're puzzled by something I'm saying. So please try and chat. It helps us to make the presentation more relevant. And there's thank you for doing that. So can't hear Chris's comments. Oh, you couldn't hear Steve's comments. Okay, Steve said that the new float, the new IPO this period is a company. Can't hear Chris's comments, only just right. Okay, sorry. And so LG is one of the biggest companies in South Korea, and LG Energy is making batteries for electronic vehicles, and they will be the platform and the go-to place. So there's a very exciting new company just floated out of South Korea called LG Energy, which is making batteries for cars. And their main pitch is, we're not Chinese, which is good. Okay. So Goldman Sachs came out with a quote on Wall Street Week on Bloomberg this weekend. They said, the US equities are like an icebreaker ship navigating icebergs. The US is most capable and will outperform other countries. In other words, they're better than anyone else, is the attitude that Goldman has. I think that same strategy applies to Goldman on Wall Street. I think they're the smartest bunch of people on Wall Street. They're breaking ice and they're navigating through icebergs. And I think they're a great company. We continue to recommend Goldman Sachs, but that's their metaphor for the month. 467,000 new jobs is the headline last week, but it's about this surge in wages. Wages are going up. And that's inflationary for many companies that have big payrolls, but companies that have expensive payrolls. So whether it's FedEx or Amazon or Walmart, they're going to have increases in their wages, but it also applies to Goldman, who's giving bonuses to the top end. The CPI of 7%, driven largely by wages, oil, and materials. Well, the fourth quarter GDP, that CPI number is for December. The fourth quarter GDP is for the 3 months, mostly in food, energy, and oil. And of course, we're recommending a food stock which is very exposed to the commodity end, Tyson Foods. Their beef prices were up 33%, their chicken prices were up 20%, and their volume was not impacted. So the stock was up 12% the day before yesterday. Trade deficit is 83 billion. So what's going on is this stimulus by Joe Biden is encouraging the US consumer to spend more money on goods imported from overseas. Now, a higher oil price means that they're paying more for oil that's imported, but they're also buying things from China. And when the OPEC countries and the other countries that export goods to the US receive US dollars, there's only one thing they can do with it. They can sell it to somebody else who's got one thing to do with it, and that's buy US assets. So it causes an inflation in the US assets. They're going to buy real estate, they're going to buy treasury bonds, they're going to buy exchange traded funds or equities, or they're going to buy US assets. So you got $83 billion in flow back of money coming back into the US, pushing asset prices up, which is at the end of the day, in effect, an interest-free loan for the US government because they're exporting US dollars that they're not paying interest on. So this trade deficit is a serious problem. I thought Trump had a handle on this. He was going to go to war with China over trade, and Biden has just let it get away again. Not very pleased with some of the stuff Biden's doing at the moment. The $19 trillion American Rescue Plan passed in March has really overstimulated the economy. And the Build Back Better Act, which it was promoted as a stimulant recovery package, is now being sold as a long-term infrastructure needs package. But I don't think America needs another $3.5 trillion in debt. And the arguments that it pays for itself because you get the benefit over 30 years is just too far down the track. Sure, there are some assets that need to be upgraded and fixed up, but to sell it as a positive cash flow act is just garbage. It's 3.5 trillion in debt, and that's debt now. So it's not good, in my opinion. Have tech stocks bottom? Well, there could be washout, Scott. I think that this could really continue to see some washout in this area. I would not own Facebook at this stage, but Facebook is becoming obsolete in many ways. There's a very funny video that I'm not going to play for you today, but it's a millennial job. Please look at it. So it's just hilarious. It's a millennial job interview where this young girl is being interviewed by a guy like me. And she laughs at him when he says, Facebook, that's for old people like my parents. It's a very funny video, so click through on that. I think there's a lot of churn going on. There's a lot of transition going on. We've got some very good stocks in there in that growth sector. Google has done very well. Qualcomm's done very well. But AMD and NVIDIA got overbought. So it's sort of horses for courses. At the moment, I think a lot of the washout's been done, but there could be more to come, and we're just cautious. But we're very comfortable with our Google and our Qualcomm investments. So it's a big question. It's a good question, and it's a long one to answer. But I think that Goldman Sachs puts it well when they say the U.S. is best to navigate the icebergs. Biden's giveaway. Okay, so Fed will taper or quantitative easing is over, and quantitative tightening will start, and they'll raise rates an estimated 5 times in the next year at quarter points at a time. We could see interest rates on the 10-year Treasury getting into the envelope of sensitivity. Right now, we're outside of the envelope of sensitivity. Interest rates are the weighted average cost of capital, hurts long-term growth, but the PEs for next year are not inside of that sensitivity band. So the interest rate increases that we see now affect the 10-year cash flows, not the next year cash flows. So it's not causing compression in the index PEs at this stage. Okay? It's causing the 10-year projected cash flows to come down, but not the PEs for next year to come down. Geopolitical risk is also weighing on the economy. The US seems to be making more out of Russia than Putin is making out of Russia, but it's certainly emboldened China's overtures towards Taiwan. And One of the big issues going on right now, of course, is not only the inflation in raw materials, but the inflation in semiconductors, which I haven't mentioned yet. And China wants to own the semiconductor manufacturing capacity coming out of Taiwan, as Taiwan Semiconductor, but there is a massive amount of new capacity coming online. And we're going to talk about how Qualcomm beat earnings estimates despite the shortage of chips. Midterm elections are going to send a big message to Washington. So, Steve, when does the election take place?
The first Tuesday of November.
First Tuesday of November. What we're going to get is a message telling Biden, toughen up on the Ukraine, toughen up on, because the Republicans tend to be much more aggressive in their foreign policy, and Biden's appearing to be a pushover. And that's why the Ukraine and that's why China are making a lot of noise right now to test Biden's mettle. As we said when he was first elected, this would happen. So expect more in this area. So those are the macro. I'll get down into the earnings now. Let me see, we've got another question.
We couldn't answer live.
Enter live.
Answer live.
Answered. Okay. Answered. Thanks, Scott. Okay. We normally produce the report at the end of the month, but in January, we have annual results, which typically come out a week later. So we delayed publishing this report so we had more earnings done. And we do have about 300 stocks having reported, with 75% beating, 5% in line, and 19% missing, which is just a little bit above average on the beating line. But the variation or the range in beats and misses is greater than normal because we have so much uncertainty coming out of this pandemic. $55 is 5.8% better than estimates and up 28% over the prior year. So that 55 cents for results includes the actuals for the 278 companies and the estimates for those that haven't yet reported. So that 5.8 better than estimate will go up, a 75.5% chance it will go up before the end of the earnings season. But again, up 28% over a very weak year last year. This week, we're going to have Disney, Fox, Tyson and Amgen came out. We're going to talk about those, Pfizer, Coke. There's still a lot of companies to come out. In the financials, there are three main themes out of this year's earnings results. And the first one, this quarter's earnings results. The first one is that we're seeing net interest margins increase. And with higher interest rates, banks like Wells Fargo are saying earnings can grow 8% this year just on an increase in net interest margin. So this will be a big benefit, not only for the money center banks, but also for banks like Goldman Sachs that have gotten into this lending business through their Marcus product, which is where they take online deposits and make loans. So they're going to benefit from this as well. There is slower trading revenue from equities and fixed income, but investment banking is super strong, and that's consistent with our investment in Goldman Sachs and our argument about the virtuous cycle. So would someone like to just briefly say what the virtuous cycle is, just to remind folks?
Well, this is one of our macroeconomic themes that we've identified and discussed for at least a decade, I think. The virtuous cycle is a cycle of mergers and acquisitions and corporate activity, which is stimulated by rising equity prices and cheap debt. And Goldman Sachs has been a consistent beneficiary of that activity, being frequently the leader in the M&A league tables, commanding about a 20% market share.
So the virtuous cycle is where companies will borrow in a low interest rate environment to make acquisitions, driving up equity prices, or they borrow to do share buybacks, and that's benefiting Goldman Sachs and our investment there. Wage pressure is typically, we'd expect to see that in the mid to low levels at Bank of America, JP Morgan, but all the banks are paying more for their bankers. And Goldman Sachs has really piled the money on top of their upper management. I think it was $400 million to all the top management, which may seem greedy, but they have the highest revenue of any firm per capita. And so it's very important to pay these high-end people what they like to eat what they kill is the expression. So you got to feed the upper management red meat is the sort of analogy that is often referred to. But by paying them extraordinary bonuses that are on top of normal things, they're saying, don't expect this every year, but we're going to give some bonuses this year to retain our top talent. So they are determined to retain the top talent. As a result of that, their earnings were below expectations, but they're going to remain the smartest firm on the street, and we're comfortable with that in the long term. The next main thing is rising interest rates is hurting fintech growth stocks, and we've seen Block fall 50% after buying Afterpay. We've seen PayPal off 33% as they're being weaned off of the eBay system. But overall, financial earnings estimates are expected to be up 23% over 2022, another big increase. And I say there's a long way to go. Before the global financial crisis, these money center banks as a group represented 35% of the S&P 500. They're now only 15%. So if we look at a long-term graph here, back in early 2000s, these stocks represented 35% of the S&P 500. Now they're only 15%. So during the global financial crisis, they had taken some very big write-offs, and then were exposed to intense regulatory pressure for about 10 years, and they've never come back to being where they were for decades before the global financial crisis. So to be at 15% of the S&P 500 is at their lows, and I feel they should be very comfortable that they'll become a larger percentage of the S&P 500 in the years to come, now that all the ugliness of the global financial crisis, which burdened them for years with very large settlements and bad reputations, is now behind them, and people will forget about that. Goldman Sachs.
Thanks, Joe. So Goldman's fourth quarter sales exceeded expectations, and one of the highlights was the investment banking division, benefiting from that virtuous cycle and contributing meaningfully to the overall growth. However, the per share profit missed expectations due to rising compensation expense. For the full year, compensation expense grew 33%, and that was in line with the revenue growth of 33%. And I think it's also important to look at the year prior, where compensation expense rose only 8%, despite another bumper year in rising revenue. Revenue grew 22% in 2020. So I view it as a little bit of a catch-up, perhaps. And I think the negative response to the rising compensation expense overshadowed some positives, especially in the digital consumer banking business, where they're making real headway. This has been an initiative under the relatively new CEO to expand into some of the more stable segments of the banking industry, because investment banking and trading revenues and profitability are notoriously volatile. So Goldman's Markets division, named after the founder, has now accrued $100 billion in deposits and generated $1.5 billion in revenue for the financial year. And they also have more than 10 million customers. As the CFO pointed out in the conference call, this dynamic about compensation expense is also symmetric. So it doesn't just increase in good years, it also can decline in poor years.
So in other words, Goldman Sachs is paying a lot in higher wages, but it's not a permanent add-on. They're saying this is a temporary bonus, or it's not a commitment to pay them this permanently. Consumer products, I'm bringing this up because I don't like them, I'm bored with them. Consumer products is generally overpriced. It got a lot of attention during the pandemic. Imagine looking at a home with a man and a wife and a baby and a teenager, and they all have shampoo, or they all have diapers, or they have something in the kitchen, or they have something in the bathroom, and they have something on the floors. And so consumer products companies, the way I think about their products, whether it's wet ones or whether it's toothpaste, I think of looking at a home and what's washing everybody down. They buy chemicals basically, and they mix them in drums, and they package them, and they market them, and they distribute them. And in the United States, people always want the new and improved product, but in emerging markets and at the Dollar Tree, they want last year's product. They want a lower price. So you tend to get the new and improved products. There's a constant battle in this industry to cut costs. So it's really advertising, buying shelf space from Costco, buying shelf space from Walmart and Kroger. Those are all well-established processes, and it's about taking another 200 points off of their cost structure to try and maintain their profit margins. So it's cost cutting, cost cutting, cost cutting. And then in the US, new and improved products to try and keep some products up. You'll have 3 or 4 companies in each product category, and you'll have a product leader. But growth is really volume and price, which is correlated with GDP, cost cutting, foreign exchange adjustments, and you get these long-term stable cash flows. And I say I don't like this sector because it's boring, mature, and oversold. And then you get Edgewell out last night, and its stock is down 12%. So it's not a very interesting sector to me. You do buy these for some yields. Some of these stocks, they've got no growth for 10 or 15 years. But if you want some yield, you can buy a tobacco company, Altria, Imperial Brands, and get 8.5% yield. But I just struggle buying those for ethical reasons. It's just boring. But when you go down to food, you might think of it as being similar in terms of volume, price, but it's much more dynamic because it's subject to emotional trends. People get more emotional about food. You can have lower barrier to entry. You can have, it's much more dynamic than shampoo. There are corporate actions, as we've seen with Kraft Heinz. You've got some acquisitions, some leverage, and it's not just about Cheerios or cornflakes. You can get spinoffs where you get margin expansion, like we saw with Dr. Pepper. A third player in an industry is losing attention from a big company. It has low margins. It gets out on its own and gets its margins back up to the Pepsi and Coke type levels, which is something we did well with. I think an opportunity continues to exist with Tyson. They're a leader in protein. So beef up 30%, chicken up 20%, pork up a lot. And then they have their packaged goods like the breakfast sausages or bacon or some of the other packaged meats, Hillshire brands. But they do have some of the lowest margins in the food sector, and that's because it's mostly bulk protein, but there is room for improvement, and they're a beneficiary of the reflation trade and the reopen trade. So if they start getting more volume going through restaurants, then they'll do well there. So Tyson Foods.
Thanks, sir.
But restaurants would pay less than
Tyson Foods had a very strong first quarter result, per share earnings and revenue exceeding expectations. And it was really a story about improving margins due to 2 factors. First of all, passing on costs. So there's been inflation experienced on the cost side of the business for nearly every input, which management have managed to pass on by adopting more variable pricing contracts, and also operational efficiencies that run out of the business. There's some receding elevated COVID costs, as well as some benefits from gains in volume. This quarter, they had operating margins almost double the prior year. And Tyson, whilst they raised prices of their major products, beef, chicken, and pork, consumers have so far continued to be willing to pay up, as reflected in the overall volume rising 0.3% on an overall average price increase of 20%. There has been a little bit of substitution away from beef, which has risen more than chicken and pork. And management has, the industry actually has received some criticism around passing on costs in an inflationary environment from the government. And management has pointed to not just passing on the cost, but also bringing operational efficiencies as the other element in improving their margins.
Protein's also subject to some import-export negotiating between governments, but terrific. Media and entertainment. We used to own Electronic Arts. We sold it at its high. It was a pandemic beneficiary. We sold it at its high, and it's been going sideways ever since. Activision Blizzard got in a lot of trouble over some of their workplace habits, and I think there was some sexual harassment cases, et cetera. They came under a lot of pressure, but Microsoft is taking them over. There's going to be a lot more consolidation in the video game business. Happy to be out of Electronic Arts. Netflix smashed on the subscriber growth. The stock price halved. So of the FANG stocks, the historical FANG stocks, Netflix is the first to really get hit very hard. And that could feed through to more negatives. Less growth, less money spent on new shows. So it could be a turning point to the downside for Netflix, as we think it's a turning point to the downside for Facebook or what's now called Meta. But CBS Viacom, they're reporting on the 15th, their stock price was trading at the low end of their 12-month range when we wrote the report last time. And now they're trading at the high end of their 12-month range. So they were up this month. This period is a 2-month period. And but they're not reporting until the 15th. So we'll look forward. They are a sub-10 valuation. And if Sherry Redstone were to give up management control, this stock could be worth 3 times what it's currently worth. So we waited for years for Sumner Redstone to try and give up control. His daughters come in. She's not giving up control, but this stock would be worth 3 times its current price if they would give up control, but they're not. So pharmaceuticals, they're constantly, having just been in the States for 6 weeks and looked at some of the needs over there. I tried to go and see a doctor. It's just expensive. It's hard. It's impossible. And it doesn't work. And it's under this constant risk of the government changing their minds, but no politicians seem to know what to do about it. None of them have any answers. And because there are no answers, there's less certainty, and it creates a lot of risk around these companies. AbbVie has this anti-inflammatory drug called Humira, which is coming off of patent after 20 years. There are biosimilars coming out. They're doing the marketing and branding to try and shore up the sales of a drug that's now really a generic, but they'll get a few more years out of that. And as a result of that, the stock was up 20% this month. They could easily buy Moderna, as could half a dozen companies could easily buy Moderna, which would be bad for us, but great for them. Viatris, as I say, it was trading at a 52-week low when we wrote the report last time. It's up 20%. It's now at its 52-week high in that channel. Earnings are coming out on the 28th. Amgen, we had a great result last night. So who's in about that?
Comes time, so I'll keep moving.
So Amgen had a solid quarter. I think one of the appealing aspects of this investment is that there's a high degree of consistency in their financial results, and they rang out some efficiencies in the business model, helping improve their margins. So we saw a very healthy earnings beat on modest revenue growth. Some of the highlights were strong growth in a couple of their portfolio of drugs, osteoporosis and cholesterol treatments, and evidently the margins attached to their COVID-related business. They're doing manufacturing of COVID antibodies for Eli Lilly that has a higher margin attached to it, so that helped contribute to the improved margins, as did lower selling, general and admin expenses. And also positively received was the annual update hosted yesterday, and that included some very long-term guidance out to 2030, and management has highlighted their ambitions for mid-single-digit revenue growth and high single-digit to low double-digit earnings per share growth. So they believe they can continue to achieve margin improvement, but some of that EPS growth will also come from management's policy of buying back shares, which has an accretive effect on per share earnings. And management have a really good history of deploying capital in a shareholder-friendly way by buying back shares, and a solid history of increasing the dividend, as they did by 10% last quarter. And that has helped the stock up to the high end of its 12-month range.
Thanks, Chris.
You gonna cover that? Yeah, we're gonna cover.
Moderna?
No, thanks. We're gonna cover that second.
Okay, Moderna down 50%, just got crushed. It is really about people taking profit from the run-up previously, but it's trading at 8 times forecasted earnings. It is not a one-hit wonder. They have a platform that can create new vaccines for variants for COVID, but they can also deliver through their package a delivery package system. They can create many more cures for viruses. So this is a company that's got a huge future, and to see it sold down the way it was this period is shocking. It's not a one-hit wonder. They can solve for AIDS, HIV. They can solve for many other things. I say double down on Moderna. Retail, Amazon had a great result. So just in quick summary, what's going on with Amazon is people going back to the stores. And we're seeing some bricks and mortar stocks starting to recover, and that should benefit Block or the company previously known as Square. But Amazon has never run their business for profit. They've run it for volume. So they're really trying to sell at cost, but they can't avoid making money in Amazon Web Services. So when they see an increase in their wages, they have to pass that through, and they've been successfully able to do that by raising the price for Amazon Prime. So the company has shown that they have the ability to push through cost increases, and as a result of that, Amazon has had a great result, a great quarter. Amazon Web Services, the different sort of business, is still leading the way and outperforming Google, outperforming Microsoft, Azure, but Amazon had a great result. So wage increases being passed through with Amazon Prime, and its net present value is less impacted by the increased interest rates. Internet stocks is where most of the action is. So the big news here, remember, you may not remember, but Facebook launched something called Libra in 2019. It was this new cryptocurrency project where they had about 24 other companies involved. And I looked at it and I said, this is ridiculous. It's dead on arrival. They changed the name to DM, and last week it was announced that DM as a project was canceled. So I refer to it as crap DM, because is everyone laughing? Am I getting a ha-ha on the question and answer there? Can someone just say LOL or ha-ha? No, I'm not getting that. Okay, so it is the crap of the day, because they've dropped this thing. Now they're pushing this thing called metaverse, and Steve and I have a different view on this, but the metaverse is three-dimensional online space for everyone going virtual and being in a three-dimensional space. Now, I think this is the next bunch of crap coming out of them. I think Facebook is seen its day, and metaverse is, well, in Latin, tomorrow is crass. So I say metaverse is the crap of tomorrow. But there's if we go back and we look at the Google Glass project back 10 years ago, it was a disaster, and metaverse has been overhyped. And Facebook was great for sex in college for Zuckerman. You know, he used to post it because he wanted to meet the girls, right? But Facebook is for old people. Now I'm going to try this because this is hilarious. So let's see if this YouTube video actually comes through. Is it gonna come through? Because this is really quite a funny little video. Oh, I don't think we can hear that. No, we can't. Let's go. I don't think this is going to work. So let's go back. Kelly, how do we go back? Can you make it go away, Kelly? Can you make me volume down? Oh. Okay. So very funny video. Click through on that. It basically says, Facebook is for old people like my parents, is what this millennial says in an interview, and it's very offensive, but it's true. Kids are using Snapchat, they're using TikTok, they're using Instagram, they're using anything, but they're not using Facebook. We're seeing declines in users of Facebook, and that and other stocks are getting smashed this period. Spotify down 30%, Netflix down 38%, Shopify down 44%, and Etsy down 54%, and many more of these internet stocks taking a big hit. So there are lots of high flyers not in our universe, but these are stocks that just make it into our internet stock list. But there are also some very good results. Apple came out with excellent results. Microsoft, really, really good results. And Pinay, how do you say the name? Sundar Pichai had some very interesting comments about Web 3.0, which we're a big believer in. So I might not like Metaverse, but I definitely like Web 3.0. And I think that's definitely coming in a big way.
Can you explain that?
Well, the internet, Web 1, is non-interactive. So people would post a page and you'd be able to go and read a page. And so that's a one direction information flow. Web 2.0 is where they track what you're doing and you have interaction, and then therefore you have ads that reflect your activity, and big data analytics will interpret what you're doing. So Web 2.0 is two-way information flow. Web 3.0 is something that we've spoken about, but it's really where you take the user at Facebook is considered to be the product. So when you post data, you're getting an ad, but you're not getting any benefit for posting a YouTube video, or you're not getting benefit for posting. What Steemit does, this blockchain company, is it says we can turn the whole economics of the internet upside down and pay people who are providing comment. So on Reddit, for example, if you post something and it gets bumped up, you would earn Reddit coin. If you're posting something on Facebook and it gets a bunch of likes, then you would earn Facebook coin. Or if you're posting something on any chat site and you're getting attention, then you're drawing attention to the system, and then you could receive small bits of coin that would be a compensation for your participation. So you're actually paying the content providers. So it turns the economics of Facebook upside down, and instead of Facebook getting money from advertisers, it can pay the content providers. But it's a really just turns the whole internet around economically. That's Web 3.0. There's a click-through on the report that you should have a look at if you want to know more about it. But it's not something that just says Facebook offers coin for people who post, Reddit offers coin for people. It's a whole bunch of different projects that are going to happen. And Steemit did it early on, but there's a lot of different ways to monetize content providers through micropayments and using blockchain technology. So that's what Web 3.0 is.
Okay. Alphabet had a blockbuster results, 33% sales growth, well ahead of expectations, about $2.5 billion ahead of the estimates. 38% earnings per share growth on top of, or I should say, in spite of record traffic acquisition costs. EPS was $30.69 versus the $27.35 estimate. Operating margins also expanded to 29.1. We always like to see expanding margins. Generally, that's well rewarded by investors. YouTube sales up 25%. That was in line with expectations, more or less. There was a slight miss on a sales basis, but they've only recently started breaking out the YouTube numbers. 45% growth in their cloud division, which was slightly ahead of the growth we saw at Amazon. Overall worldwide, only about 15% of corporations are cloud networked, which lends to the argument that there's a lot of runway for these cloud providers. And it appears that Alphabet is gaining market share on Microsoft at least. They also announced a 20-for-1 stock split. Of course, this is meaningless as far as the underlying earnings that each share represents, but it might benefit the stock price in that it's more appealing to retail investors, and it can also be included in some ETFs that are price weighted versus market cap weighted ETFs like the S&P 500 ETF you might find. Market cap weighted is S&P 500. Dow would be a price weighted. It's trading on 18 times earnings, and if you cut out the cash, it's about 17.5 times, which seems like very, very good value given the continued strong and robust growth.
So we've had Microsoft. I think we paid 18 times earnings for Microsoft about 5 years ago, and we've made about 30% a year out of that stock. And it's been Alphabet. What did I say? Microsoft, Google or now Alphabet. Semiconductors. There's a shortage of semiconductors, and Taiwan and Samsung are not able to make enough chips. But the announcements of capacity expansions are gigantic. So the amount of money that Applied Materials is going to make, or anyone making the like Ultratech Step, or anyone making specialty tools to build plants, there are going to be a lot of chip factories built, and that's going to give Qualcomm the ability to contract manufacture chips at either Samsung or Taiwan. But for now, Qualcomm can't get enough chips. But there is maybe too much capacity coming on. As a result of that, NVIDIA, AMD down 23 and 20%. They're expensive. NVIDIA was getting close to $1 trillion market cap. AMD was doing very well, but they're down. Qualcomm is doing very well. And what's going on at Qualcomm is that not only do they make communication chips for phones, where Apple wants to do their own thing, but they're also expanding into new areas, and that's cars, which is a small part of it. And the other area that they're in is in RF devices. That's converting the signals to radio. And then the third area that they're in is in what's that? Internet of Things. Yes. So they're seeing some really good growth in demand in their other sectors, but they're not supplying. They're only selling to the phone companies right now, with pent-up demand at auto Internet of Things and at RF devices. So we're going to see those sectors do much better once some of this new capacity comes on, and there's a lot of upside at Qualcomm. Stock was up on the news. Boeing, you want to cover Boeing?
Yeah, I'll discuss Boeing. So Boeing is, despite the volatile and negative headline financial results, making good progress on the turnaround. And for the full year 2021, sales were down 3%, and they had a pretty large headline loss. But most of that was actually driven by non-cash charges in the fourth quarter. And some of the key metrics that we're looking at, all investors in Boeing are looking at, is the cash flow and balance sheet situation. Boeing still has more than $16 billion in liquidity. Importantly, in the fourth quarter, it was the first quarter in more than 2 years where they had positive operating cash flow, and they expect to have positive cash flow in 2023. And that's important because the cash burn and liquidity constraints are what prompt the company to need to raise capital. And as investors, we don't want to be diluted. So we think that that risk is minimal, or has been addressed by shoring up the balance sheet in the years gone by. Whilst Boeing refrained from providing financial guidance, some of the leading indicators that we're looking at that support our investment thesis around the recovery from COVID and the production issues with the 737 MAX and Dreamliner. Some of those leading indicators include the growing order backlog. Orders are exceeding cancellations, and the backlog now represents about 4 years of normalized commercial revenue of about $70 billion a year, 5 years now. And the travel numbers that the Transport Security Administration reports, you can visit their website. The travel numbers are running at about 75% of the pre-COVID level, and double what they were last year. So there is recovery on that front as well. And that all supports our investment thesis for the continued recovery at Boeing. Our assessment of the normalized earnings potential is about $15 a share. And at the current price, Boeing represents about 14 times that. So we think it's a very reasonable price to pay. It's a multi-year investment proposition, and we're comfortable sticking with Boeing being one of the majors in a global oligopoly.
So recovery trade, and it's gonna do well. Just gonna skip through to energy, which is the biggest mover in the market. You can see the price of West Texas Intermediary was negative in April last year and is now $91. The swings here in the price of oil are very dramatic. It's not generally caused by a change in supply. The world supply is about 100 billion barrels a day. It's by changes, in demand. It's not changed by demand. The world needs 100 billion a day. It's changed by supply, where OPEC and Russia might tighten how much they're releasing, or they might release more, and that'll affect the price. So we've seen some really big swings in it. Ironically, Biden is largely responsible for the big surge in prices. So even though Donald Trump was supportive of the oil industry and opened up the Alaskan drilling, was supportive of the Keystone Pipeline, ironically, it's that Biden does not support the Keystone Pipeline and does not support Alaska, that's reducing the supply and driving the price up. And we also have geopolitical risk. But there's a lot to talk about in energy. I haven't saved enough time for it today, but we're seeing some big swings, big changes. I think the best thing that these oil companies could do right now is simply not spend this windfall on exploration and production, but try to return some of this money to shareholders, because this is a temporary big surge in the price of oil and the price of these stocks. So we hope that whatever excess cash flow they have now, they'll pay back in the form of buybacks or share buybacks. If companies get real aggressive in announcing exploration and production or expansion capacity, we would expect that to be money wasted. The relative value model is unchanged. We're recommending Goldman, Tyson, Viacom, Viatris, as many of these sub-10s. Amgen had a great result last night, up about 10%. Moderna, Alphabet's performing very well. Moderna is down 50%, but made up for during the period with big run-ups in many other stocks that we own. And then in the current week, not included in this performance, we've seen the 12 to 15% run-up in Tyson, and the last night's 10% run-up in, well, not quite 10% run-up in Amgen. So overall, it's a good long-term performance. That finishes the presentation for today. Would have liked to have more question and answer. Would like to see you all in here. We would just running up to 2 o'clock. So that concludes our presentation for today. Kelly,
Thank you, Joe. Yes, so a replay of today's webcast will be made available shortly after the conclusion of this event. Listeners with additional questions can contact myself or the team via phone and email per the contact information available on the website. Thank you everyone for tuning in. That concludes today's webcast. We hope you stay safe and we look forward to speaking with you again. You may now disconnect.
Thank you.